In this video, we're going to talk about distributions to shareholders. So what's this all about? We're talking about dividends, right? But not just dividends. The dividend policy. How do managers decide how much to distribute to their shareholders? Now, there is an alternative way to get money back to shareholders. Dividends is the primary one. But a popular way of also getting money back to shareholders is what's called a repurchase of shares, repurchasing shares. So we're going to discuss those in context of how managers think about this. What is their process? So again, what is dividend policy? Again, it's the decision to pay out earnings versus keeping them and reinvesting them. So what does the policy include? What's the size of the dividend payout? Do we do a high payout, low payout? Is it stable, or do we do irregular things? How frequently do we pay dividends? How do we announce the policy? All of these things are part of the general idea of management must make a decision on how to do this. So there are several theories about dividends, and we're going to start talking about what they refer to as a dividend irrelevance theory. Now, what does irrelevance mean? Well, this essentially just means that investors do not see a connection between dividends and prices. That if you change the dividend of the company, you won't see a change in the price that comes from that particular change. The basic idea of this is that investors can really create their own dividend if they want, right? If the dividend wanted or needed more cash, they could just sell the stock. If they don't want cash, if they don't have a need for it, then they can use those dividends to buy more stock. So this process is what we sometimes refer to as homemade dividends. You create your own cash flow stream. Now, this is proposed by Modigliani and Miller from the late 50s, early 60s. It's been around for a very long time. And just like every other theory, there are some rather unrealistic assumptions. The biggest of those is that there's no taxes or brokerage costs. So how strong of a theory this is as far as actually telling us what's going to happen, and there's obviously some questions. So we need to have some testing, and testing has gone on since the early 50s here, or late 50s and early 60s, about this theory. So why might investors want dividends, right? One of the reasons is they may think the dividends are less risky than cash flows, or than capital gains, So if that is true, then they have a preference for wanting to get paid dividends because that is a less risky form of investment. So again, this particular idea where they might want dividends is what's sometimes referred to as the bird in hand theory. It's better to get a bird in hand, get the cash flow that you're certain of, than that payout in the form of a price later on. Why might they want capital gains? They may want to avoid transactions costs, right? Again, if the price is increasing, that realized return is not taxed. There's nothing we have to worry about on that at this particular time. Legislation is thinking about this, but I'm not certain exactly how that ultimately even be practically implemented. So the idea here is if you're going to get preferred, if you want preferred capital gains, you're essentially saying, I don't want to pay taxes. So taxes are due in the year they're received. Capital gains are due whenever you sell the stock. So if you hold the stock until death, the beneficiaries use the date of death as the cost basis, and they're going to escape all of those previously accrued capital gains. This is an estate tax law that certainly most middle-income families take care of, right, or utilize in some of their planning. If you hold it long enough until the person's death, then all those assets transfer to their beneficiaries at the value they are at death, so the tax is then is sidestepped, if you will. So let's think about, we had talked earlier about something called the signaling hypothesis or the signaling theory when we had a video about capital structure. Well, it's back again. Investors see dividend increases as signals of management's view of the future. Again, the idea, the foundation of this is that managers know a lot more than anybody else. So if they decide to do something, we have to assume they're doing that logically and with investors' best interest in mind. So managers are not going to want to cut dividends because investors are going to view that as a bad sign. On the other hand, they're also not going to raise dividends unless they think the increase is sustainable. Well, let's just think about this. Why would they ever want to reduce dividends? The only reason is that it has to be something so bad has happened that they need the cash so badly that they can't pay the dividend. And of course, that's catastrophic for the company and therefore for the owners. Why would they ever increase the dividend? Well, they would only increase it if they thought they could keep it at that next level. Maybe they have a new plant that's just coming online, hasn't produced any cash flows yet. The cash flows from that plant are going to go a long ways to covering the dividend increase. Now, a stock price increase at the time of a dividend increase could also reflect other things. It's not just here, right? But again, an increase in dividends can reflect maybe higher expectations of future earnings per share, right? It's a signal that management thinks the future is going to be better than today. There's something that's frequently referred to as the clientele effect. Different kinds of groups or investors prefer different dividend policies. Right? A wealthy person is going to prefer lower dividends because for lots of reasons, but number one, they just don't need the cash. They want to maybe avoid taxation, etc. But there are individuals who need the cash. They want to get paid dividends. So the idea here is that the dividend policy of the company attracts certain kinds of investors. So if you have a high dividend payout policy, you're going to attract investors who want high dividends. What happens if you change? Well, the idea here is if you change, those people that now, if you went from high dividend to almost no dividend, those people are going to be unhappy. They're going to sell their stock. They're going to get out. But unlike other kinds of selling arrangements, there's somebody on the other side that wants low dividends. So this is not going to affect the supply and demand curve because there is an equal demand for the dividend policy that people are selling. So again, this clientele effect impedes changing the policy, because again, it might in the end hurt those investors who have to switch, mostly because of taxes and brokerage costs. But again, without taxes and brokerage costs, it really doesn't matter what the company does. If they change, they get new owners. And the company itself doesn't really care who the owners are. They just need somebody to have invested and provided some funds. What's referred to as the catering theory sounds a little bit about the last clientele effect, but this suggests that investors' preferences change over time and that corporations will adapt their policy to cater to the current desires of investors. So again, they're more likely to initiate dividends when dividend-paying stocks are in favor, for instance, and then they're more likely to admit dividends or reduce dividends when capital gains are preferred. Now, when I say reduce dividends, I'm not talking about the dividend itself. We're really talking about reducing the dividend growth rate, right? Because as we remember in a previous hypothesis, we know that managers in general never want to reduce the dividend. So if you're paying a dividend payout rate of 50%, and you decide, really, we usually grow this dividend by about 2% per year. Instead of it growing by 2, it grows by 1, right? It's still growing, but it's growing at a slower growth rate. So this catering theory just complicates the decision by trying to gauge what the actual investor wants from the company itself as far as dividends are concerned. Now, there is something that's referred to as the Residual Dividend Model. And this is a very basic model. Well, essentially what it does, it gives us a baseline, if you will, of maybe what our payout ratio should be at a minimum, if you will. So what we need to do here is we need to find out what retained earnings we need for the capital budgeting decisions of the company. If there's any leftover retained earnings, if there's any residual, that's paid out as a dividend. However, it also implies that if there's nothing left over, there is no dividend. So this policy minimizes flotation and signaling costs. Hopefully it would minimize the weighted average cost of capital of the company. But it also creates a very unstable dividend itself. So let's see how this might work. We have a capital budget of $800,000. The company has a target capital structure, 40% debt, 60% equity. So of this $800,000, the concept is 60% of that is going to come from equity. Now, we know that there's two forms of equity. Equity is either retained earnings or it is issuing new common stock. So we need to find out whether or not we have enough funding to fund this capital budget in the capital structure theory or concept that we want. So we have $600,000 in net income. So how much of that income should be paid out as a dividend? Well, let's see. Of the $800,000, again, 60% equity, $480,000 would be funded with equity itself. So calculate the excess or the need for equity capital. If we're going to get $600,000 in income, that means there'll be $120,000 left over to pay as dividends, and the dividend payout ratio will be 20%. Now, what happens obviously if income changes? If income were $400,000, then the actual amount to be paid to dividends is negative $80,000. So in this case, the answer is the payout ratio would be 0. We wouldn't pay any dividends this year. Of course, if it was $800,000, if it goes up, income goes up, we'd even pay out more. So the downside to this particular theory, as we'll talk about, is that it really creates a very unstable dividend payout stream. And of course, if investments change, that adds another layer of difference, right? So income is going to affect it. The amount that you need to invest in is also going to have to change. So there might be times where, good investments, if you have a lot of good investments, you're going to have a very low dividend payout. Isn't necessarily bad if they're good investments. The challenge is, what do investors want? What do they expect to get from the company? And investors' expectations are just as important as what the company wants. So the advantage to this is it minimizes stock issues, right? We're not going to issue stock quite as frequently, maybe. Some flotation costs will be reduced. But the disadvantages appear to be more. Variable dividends, conflicting signals could increase the risk of the company. And really, it doesn't appeal to investors. So in conclusion, right, the residual policy, if you're setting a long-term target payout policy, might be okay, right? But you probably don't want to follow that rigidly, right? We want to always maintain a stable, consistent dividend payout. Look forward to seeing you in the next video.